Welcome to the NGEN Markets Training session. So meanwhile, others are joining in. We will start with our topic for today. So topic for today is analyzing custom securities. So we will touch point three, key major points. One is how do we add custom data sets in NGEN Markets? The second would be to how to analyze these data sets, these custom securities against a suitable benchmark. And the third would be comparing custom securities with each other, which you have already added into the system. The fourth point would be a bonus point where we would be talking about custom securities which you can add it in a portfolio and then run it based on your own custom security analysis. And then in the last point, we will be taking a look towards the Q&As. So if you have any questions, any doubts, any queries, you can shoot your questions either in the chat box or via verbally after the session. So I hope my screen is visible and we can start with our session for today. So let me just show my terminal so that we can, proceed. So as you can see, this is the NGEN Markets terminal we have, and we have a couple of things which we can discuss in this session. But the major key point is how do we actually add in custom securities? To add any custom securities, you need to head over to the last tab, which is called as My Security. Now, talking about My Security, it is a very underrated tab because it helps you to analyze any data sets, either it is a monthly or a daily data points in our system, and then compare it with one particular benchmark. So let's take a use case and let's add in a custom security for your own analysis. And then we will also see all other data sets compared in our system in one single tab. So to add any custom securities, you can see there's a plus button here in the left side. So all you need to do is click on this plus button and you will see these boxes which will open up once you have clicked on this button. Now, how do we add in a custom security and how do we, use these data sets? The first prerequisite would be to have your own data sets. So I'm going to show you my own data sets so that you can then compare it, and we will show you what kind of a format do we accept to run the analysis. So let's take a look towards the data sets which is not in a domestic market. We will take a data sets like an index fund of Vanguard, right? So we have these data sets. I'm just going to share these data sets in front of you in an Excel format, right? So this is how, the data sets looks like. Now, one data set would be the date format, which is given in the A box. You can see that these are the date format which we accept, and other is the price series. So price series of Vanguard 500 index fund is actually added in our Excel sheet. So what you can do is you can copy these data sets and add it in our system. But before proceeding and copying our data sets, I'm going to discuss about the date format. The normal date format, what engine accepts is this one, right? But the thing is that it also accepts this date format. So, if you have either of these, it doesn't matter. All you need to do is just copy and paste it in our system, right? Let's say we are just adding in couple of data sets in front of you to show how the capturing of data sets works out. So all you need to do is just copy these date series and the price series. So I'm just going to control C up here. And once I copy this, I can head over to my engine terminal and I can see this dialog box, which is called as copy and paste here from Excel. So all I need to do is just paste this 5 to 6 data sets, 7 data sets, and then validate the input. Once I validate it, you can see the price series and the date series, which is it has mapped in. It is a analysis which will show you all the data sets together in the system. So here you can see the 7 data points, the start price, the last price, and then you can save this chart with the basic info above, right? So what you can do is you can save it, let's say save one, right? Choose an asset class, let's say other, and validate it. And once you save it, it will be saved in another asset class here. Once you click on this collapse all, you go to the other folder, and you can see this is the data sets which we have previously added, and it only includes the 7 data sets, right? So what about many data sets? How do we add all the data sets in one single go? So let's head back to our Excel. So I'll just show you my Excel again. So heading back to the Excel, you can see there are too many data sets which we already have from 2010. Now what you can do is you can just take all these data sets, copy it and paste it previously what I've done before for the analysis. So all I need to do is just click on this add a new security, right? I just need to copy this up and all I need to do is just add in the name. So I'm just gonna add Vanguard VOO March, right? Once I've added this, I select the equity asset class, I validate the input, and you can see now a lot of data sets. Its data point is 3256. It's more than 3000, and you can see all the data sets which is mapped out in the engine system. Now here, when you zoom it in, you will definitely see that it is calculating on a daily basis. So I'm just gonna show the zoomed in section. So when you click on it, you can see the data sets are currently calculated daily as we have input the daily data sets for this particular set of the index fund. Now, once I save it, it will be then saved in the equity folder of it as we have selected an asset class here. And then what you can do is you can analyze that custom security. To analyze that custom security, once it is saved, it takes a couple of seconds, and once it is saved, we can then head towards the analysis. Now all you need to do is just click on this collapse all. The benefit of this is it collapses all the folders in one single go, and then you can click on the equity, and then you can go ahead and select the Vanguard VWO March datasets which we have chosen currently. Once we click on it, you can now see the analytics which will then run just like all the mutual fund stocks or a portfolio which we can previously run on a domestic equity or a debt mutual funds, right? So what you can do is you can now map the performance of a Vanguard index fund with a suitable benchmark. Now, how do we change the benchmark? You can change the benchmark from here. So let's go to the others, because this is the benchmark which will be more suitable for this particular index fund, and we can choose S&P 500. Now, as you know that Vanguard is actually mapping S&P 500, so we would like to test this particular set of an index fund, that is it actually outperforming the index, or is it actually having a better tracking error, or is it a really good index fund or not, based on certain sets of performances. So let's head over to the performance analysis of any custom securities. Before going ahead, you can actually analyze any custom security given here in the system. All you need to do is just click on it. I've already preloaded couple of stocks which are foreign stocks in our system. All I need to do is just click on it and it loads in, right? And once it loads in, you can then map out the performance based on your own preferences, right? So here what you can see is you can see the performance stats. Now this performance stats would look very similar to you based on the portfolio analytics which you have taken a look towards before. Here, what you can see is the performance which of our asset, which is the Vanguard Index Fund, versus the benchmark is pretty high. It's actually beating the benchmark on a uh, basis of 2% return sets, and you can also see the volatility. Now, the volatility here is very marginally similar, but our index is actually having a marginally low volatility, but yet it beats the benchmark accordingly based on the performance of this historicals. And then we have the historical value at risk. Now mapping the performance on the basis of returns or the CAGR is one way. Another way is to check the risk of this particular set of an asset. To check the risk, the best way is to check the value at risk model. Now, the value at risk model which we have checks the downside risk based on the percentile basis. Now, what do? Is we check on a confidence interval of 95%, that there is a 5% chance, 100 minus 95, that this asset could have a loss of negative 26.50%. So you can see that the losses are also marginal between the two asset and the benchmark. And the implied also means the same. The main difference between the historical and the implied is just that historical is calculated on the daily returns of the entire historical datasets, and implied is calculated on the basis of volatility of that datasets. So you can actually change the confidence interval here. So let's say if you want to change the confidence interval from 95 to 99. So now the confidence interval is 99. So we can now, map out that there's a 1% chance to have a certain loss. Now this is certainly risky. You can see it's negative 50.27, but yet it is lesser riskier than a benchmark, right? So you can map in any custom security, not just a Vanguard index fund, any index fund or any particular set of a custom security in our system to come up with a suitable set of performance comparative analysis, right? And then we also have a relative tab which shows that versus S&P 500, how this particular set of an index has behaved in the last 5 to 10 years. Now, 10 years in the sense we have chosen a data sets from 10 to 13 years, and you can definitely see the excess return over the benchmark is pretty high. And the tracking error is 3.48, which is pretty low. So tracking error is basically what it tracks. It tracks the daily return sets and shows the standard deviation difference of those daily return sets. So the lesser the tracking error is, the more it shows that it is tracking that particular set of a benchmark accordingly. The higher it is, let's say 8%, 10%, then it is not tracking that benchmark as suitably as regarded. And then we also have an info ratio. So info ratio is another way to understand that if we are positively different than the benchmark or negatively different. And if it is a very high info ratio, it means that we are having a better alpha and also, mapping it out properly in a tracking error. So what the main point here is that info ratio is just a ratio between an alpha versus the tracking error. So it's a, difference between the performance of our asset versus the benchmark upon the tracking error, which we have considered here. And also another great way to map out any particular index or relative performance is to check the capture ratios. Now here you can see some numbers like 106.19 and 96.93. What does this signify? So a capture ratio, higher than 100, when it is an up capture ratio, it is regarded better because it is getting a better return sets when the benchmark is up. Now what you can do is you can click on this I button, and you can see here that the return of the asset is actually higher than the benchmark. And you can see the monthly data points. Now, the point here is, the beauty here is that you can see the monthly data points of our assets versus the benchmark performance, and you can just scroll in. Now, this is only for the up markets, only when the benchmark was positive. You will not see any negative in the benchmark here because negatives would be there in the down capture. So when you want to check the negatives, all you need to do is head over to the down capture ratio, click on this I button, and now you can see that when the benchmark was, negatively backtesting, it had a negative return. How did our asset perform? How did our index fund perform? And you can see definitely that we are, similarly performing when the, benchmark was down. But you can see the return sets are pretty, marginally better when the benchmark was down, right? So that is how you can check the up captures and the down capture of any particular set of a, security versus a benchmark which you have chosen. Now, let's say I want to check the benchmark for not for S&P 500, but I want to check it for Dow and Jones. So all I need to do is just click on Dow and Jones. Now you can see that there's a difference here. You can see the up capture is pretty high, and also the down capture, we are actually having lesser losses than the benchmark, right? And another thing is to map the performance. Now, this is not a relative tab, but this tab also helps us to understand what has been the frequency of the monthly return sets of this particular custom security. A monthly return sets basically means that out of all the 5 years, we have 151 months, which is the number of periods. And you can see the up months, the down months, and all the frequency of the up and down months. Up basically means the positive months. The down basically means the negative months. So these are the positive up months. These are the negative, down months. You can see negative 3.68. So on an average, they are having a, pretty similar average in a positive and negative. And you can see the volatility of those months with the best positive returns and the worst negative return as well. Now here, for a monthly stats can also be translated into the yearly stats, because here you can see the yearly stats that, out of all the 12 years, or, out of you can see what are the up years and the down years. It works similarly to the monthly stats, but now you can see on a yearly format that what has been my average up years. So it's 17.70. And you can see all these interpretation of the data sets in this format, where you can see the up years and the down years, and even the up months and the down months. We can also zoom it in to check the particular set of a month. Let's say a month of, the COVID month, you can actually see all those, losses in the COVID, like March 2020. And that's how the monthly performance has been for this particular set of an index fund, right? So this is one, performance analysis which you can take a look towards when you're, choosing any custom securities, because this is where you can understand and then, hopefully compare other custom securities in our comparative tab. Now, next point is to check, how do we check rolling analysis of this custom security? So rolling analysis is another great way to check that. Let's say we are considering 260. 260 is a working period in a year. So it's a 1 year period. 520 is 2 years and 780 is 3 years. So here you can actually change these data sets if you want. So let's say we are considering 260 for all, right? So to keep it pretty seamless, I'm just running this 260 for all, and you can see only one data sets. Now here, what you can see is that for a 260 data point, which is a rolling analysis, any data point which you choose, let's say 21st May 2014, so 15.72%, that is the sum of the previous 260 days daily returns. Any data point you go ahead would be the sum of the previous 260 days. Now this is an absolute data points. Now here, what we are running is from a particular start date of 2010, we are running it till the current date. And this average is all, all the rolling data points which we have for a 260 period, which is 13.49%. Now this helps us to understand what is the average 1 year return sets, right? Now here you can also understand that what has been the highest return for a 1 year for this particular index fund, which is 61.52, and what has been the lowest return sets, which is 19.20. Now here you can change the data points. So my point was, let's say I make it 520 again and I run it. Now you can see now difference, 520 would be the sum of the previous 520 data sets. And now once I make it annualized, now I can easily compare it. And now I can easily say that the volatility has decreased and the average has increased on an annualized basis for a 2 year period. So holding this particular index fund would be better for a 2 year period rather than a 1 year period. Now you can change the period for 2 year, 5 year as well. 5 year can be 1300. It is just multiplying 260 by 5. And once you run it, you can now see the 5 year period. But the major point here is the average might have decreased, right? But you can see that the low is now positive. Now you can see that any data point which you choose here, it has not backtested, negative return sets for any particular set of a rolling period, right? So that is how you can take a look towards rolling analysis. And another great way to see rolling analysis on a probabilistic basis is to check the return ranges, because here you can set an expectancy. Like for an example, what if my client is expecting 10% to 20%, right? So you can just change the any interval here. So all the intervals are customizable in itself. And now you can see that there is a 39%, which is close to 40%, frequency between 10 to 20% for a 1 year period. So my probability here is increasing if I am, expecting between 10 to 20. But what if I'm expecting very highly from such a fund, let's say 20 to 35%. So what does, what does it display? So when I make it 35%, you can see that its, distribution is 23%. It's almost the half of 10 to 20%. So this is how you can set an expectancy. And also another expectancy you can set as that if a negative return is considered, right? Let's say we consider the least return sets, let's say negative 100. What is my chance? So 10% chance I could go into negative for a 1 year period. I invest in this particular index fund. The 1 year period, there's a 10% probability distribution which has already happened in the previous 12 to 13 years. Now here we have another great tab to understand the weighted probability return. Now let me just run this again to show the weighted probability return. So what you do is you run the rolling analysis. You come to the rolling analysis here. And here, what you see, it has mapped out the minimum return generated by the index fund and the max return, and it has divided those intervals into 5 sets of intervals for your own distribution. Now here, what it does is this weighted probability return takes into consideration of all these distributions and multiplies it by the midpoint of the data sets, which is between 90 to -3, or -3 to +13, and then you get a weighted probability return. Now this does not include the remainder. If I choose to have, let's say, 40 to 50%, then it will only consider till 50%, and not, these remainder will not be included, this remainder data sets. So this weighted probability return is another great way to understand what is the probabilistic view of any index fund or any security when you are taking into consideration. And furthermore, we also have the rolling volatility statistics, which shows, the average volatility high and low for volatility which is running through in our system. So the volatility you can see here is specifically 260 days rolling volatility. And you can see how the volatility has changed in 2016 year. It has actually shot up for a 260 days. Another change was here in 2019, which is kind of like an you can set a scenario here, and you can also see another volatility, which actually you can see the volatility here for the COVID period. So here you can see it has shot up pretty high. So this is a rolling volatility. It's a rolling standard deviation from a start of one particular start date to an end date, right? So that's how the rolling volatility works out for this particular set of security. And this is what rolling analysis holds. Now, another great thing to check is the drawdown analysis. So, we are just mapping out couple of tabs, and then we will start comparing this custom security for the further analysis. So here, what you can see is the drawdown for single security. Now, the drawdown, which you see here, is basically mapping out how the strength of this particular set of a security is based on the losses and its recovery. Now, the loss you can see here is given here. We had a previous loss, which is a drawdown at 19th February 2020, and the end date is 23rd March 2020. And you can see the days to recover was 100. Now here you can see another loss which happened in 2022. Now it's a current one and it's still ongoing. It's only 37% recover. Now what is drawdown? Drawdown is basically peak to trough analysis, and then trough to peak for the recovery. So peak to trough shows you the drawdown. I'm just going to highlight this by zooming in. So it calculates daily data points and then sees that where the drawdown happened, where the worst drawdown happened, and how it has started recovering every single data points you can see, and then it has recovered for a one particular data point. So you can see the drawdown and the recovery and the number of days it took to recover, and the recovery date is it holds. Now, drawdowns, you can also do the comparison in our comparative tab. We can take a look into the next, particular few minutes for the drawdown comparisons. And then we also have another great way to check, the drawdown and the comparison within an index by checking out scenarios. Now, the scenarios is another great way to check, because what I can do is I can go to the scenario analysis. I've already preloaded one or two scenarios here, but we have given you inbuilt scenarios. Now, inbuilt scenarios are given by, as a default section to check out, on a seamless basis. Let's say we are checking Fed rate hike. Now, you can see the Fed rate hike versus, we have to change this benchmark here because it's Nifty 50 currently. So let me change the benchmark. Now you can see the scenario given here. And when I check the Fed rate hike, you can see that the excess return is marginally higher. The correlation is very similar to the particular set of the benchmark, and we have given better return sets than the benchmark in that particular period. Now the period considered is 1st Jan 2016, 1st December 2016 to 30th December. Now you can choose your own scenarios yourself. To do that, all you need to do is just add custom scenario from here. You can go ahead with the start date. So for a start date, let's say we are choosing a scenario of, let's say 2020, and we are just taking a consideration of COVID here. And another scenario, we can just keep an end date of, let's say, March or April, let's say 4 months, right? And you can save as a custom scenario as COVID, right? And then once you save it, the custom scenario is now saved. You can see COVID is now added into our system. And once I check it, you can see that our access return over the benchmark, which is an alpha for this period, is 0.58, and the correlation is this. And that's how you can check, any particular set of data sets. Access return does not mean that we have given positive return sets, because here you can see that our index has, in our fund has fallen, index fund has fallen, and even the benchmark has fallen. But we are the one which has, which we have fallen lesser than the benchmark, right? So here, what you can check is the scenarios for any particular date sets which you choose to have. The one which I've already added is 2021, which is the Joe Biden, election, where he was, elected as a president. And you can see that, the excess return and the correlation and the custom security versus the benchmark. So that's how you can analyze custom securities. There are furthermore many tabs, just like other tabs, like the beta analysis, which you can check against a benchmark and choose a start and end date. So all you need to do is just keep a start and end date, and then choose in accordingly, and you can see the beta accordingly for the system, right? And then we have a distribution analysis, which is quite statistical, but you can see the observations for a daily, monthly, and a weekly return sets for any custom security. So this can be another session anyway, but this will help you to check the distribution for a large, huge data sets, and to see what has been the mean, median, mode of these data sets for one single custom security. Now, coming to our second point, how do we compare custom securities, just like Vanguard versus a particular set of a stock like Bank of America, JP Morgan, and even an index, even an Indian mutual fund or Indian stocks. How do we compare them with each other? To do that, all you need to do is just go to the compare section. And now compare section is very robust in adding any securities which you want. The first prerequisite which you need to have is already saved. It should be saved in your system through you. And what you can do is you can add other items from here. Now, what I'm going to do is I've already saved a couple of, stocks here, just like JP Morgan. I'm just adding them one by one. And, that's once it is added, then we can start analyzing them and we can start comparing them. Even the Vanguard one, which we have already added in front of you. So now we have like, five stocks and one, index fund versus also an index. Let's say we are adding S&P 500, right? So, I'm just adding S&P 500. So this is another, index which you can add. Let's say we are also adding NASDAQ, right? Now we have a couple of custom securities, two indexes to compare with, and now we can analyze from any data points which you want. So the data points are huge, like it starts from the main list to the last 12 months. I'm just going to explore a couple of data points, relevant ones, which will help you to analyze them effectively. The one data point is to check how they are behaving on the price series momentum, which is the correlation analysis. Now, correlation analysis at Engine is calculated on the daily data points. As it is calculated on the daily data points, you can see the date sets here from 5th March 2018 to 2nd March. This is our data sets which I've chosen anyway. And what you can see here is the higher correlation is, effectively, as you can see here, should be with Vanguard index fund with vis-a-vis an S&P 500, because that index fund is actually mapping that index anyway. So a 0.97 is a very high correlation, right? Whereas a point something like 75 or 65 or 67 is a low correlation in equities. Like for an example, when you see this one, right? Netflix versus Google, it's having a lesser correlation against each other. You can also check the Netflix versus S&P 500. It's definitely having a lower correlation versus that particular index. Now, what about another correlation which you would like to check? Let's say we are checking a correlation for banking. We have JP Morgan here. Let me just add another one which I have already added, which is Bank of America. Now, Bank of America and JP Morgan tend to, correlate highly with each other because they are in a similar sector. And, the data points actually suggest that as well. You can see the data points 0.93 is actually a high correlation, which you can see the Bank of America versus JP Morgan is 0.93. So the point here is something, a data point which is closer towards one is a high correlation, and data points which is farther away from one, which is like 0.34, 0.25, it's actually a lower correlations compared to each other. Now it depends what kind of securities you're correlating. If let's say I'm adding a mutual fund of, definitely it won't be correlating highly, but we can just test it with our own hypothesis that let's say if you want to test an Indian mutual fund with a particular set of index, let's say S&P or NASDAQ, you can effectively do that. And you can see that how we are correlating with how the index, how the mutual fund of India is correlating with other funds, index, or even a stock accordingly in our system. So that's how the correlations works out. And apart from correlations, we can also check the drawdowns again. Now I'm going to show you why drawdowns again in the compare tab, because drawdowns helps us to understand what has been the risk and the recovery, right? Now here the comparative drawdown helps you to check all the 5 drawdowns from worst drawdown to the 5th worst drawdown. And then you can compare with the basis on the basis of 3 statistics. One is the size of that drawdown, the worst one. So let's say, comparing all the equities which we have chosen here, which one is having the highest loss, worst drawdown in the last 5 years? It's basically, Netflix, right? And you can also see how much time it took for that particular size. So, the biggest loss, ongoing loss was with Amazon. So had you hold this particular stock for a longer time period, it would have been a huge downturn in your portfolio because its length is very high. Length is basically the number of days for that particular size to occur. Now, if you want to check the size, the drawdown, and the recovery for an individual particular set of a security, you don't have to go ahead and back into the custom security. All you need to do is just click on this. This is the graph button icon, where you can then see the same statistic which we have explored before in our custom security analysis. Here you can see the start price, the end price, and the recovery. So here you can see the start and the end, which is basically when the drawdown started, which was this particular set of a date, and when it ended, which is this date, and how much it has recovered. So it has just 10% recover for this loss of negative 56.15%. And it's still ongoing. And there's another set of a loss which is ongoing is, it's not even recovered yet. I mean, not just even a portion of it. So here you can check the drawdowns for every single top 5 drawdowns. Let's say we want to check that the top 3 losses, one of the second worst drawdown, which one is having the recovery. So these all are having recovery. Even Mira Asset Large Cap is not having recovery as of now in this particular set of the drawdown, right? So that's how you can compare the drawdown. And one important thing you should consider when you are comparing the drawdown is the start date, because start date is considered as a minimum common period. Now you may know that we have added a fund which is older than a 5-year period, and even a Vanguard index fund is older than the 5-year period, but it does not go beyond that because of the minimum common period of this particular stocks like Netflix, Amazon, and Google, because we have already added only 5 years data sets for the comparison for this particular set of the session, right? So whenever you go back, you always see that this is a minimum common period when we consider comparing the drawdowns, because we can't have single different start dates for all different particular set of the securities in the compare section, right? You can change any particular set of date sets here. So from 2nd March, what was the worst drawdown? You can see only JP Morgan and Mira Asset has actually recovered, others have not, right? So that is how drawdowns will be pretty useful if you want to check the comparisons and the strength and the recovery of those particular assets which you are comparing in our system. Now the last point is to check the calendar years. Now calendar years is another great point that it depends on how much data sets you've added, but it gives you a simplistic view of the data sets. Let's say what has been the positive return generating assets. The US markets, effectively most of them have not returned that much. All are in negative. Only one, which is our a mutual fund, which is in positive, right? And you can check that out for any particular set of securities added in our system. Similar to the calendar years, if you want to make it a simple scenario based analysis for all the securities, then you can head towards the point to point. Now I'm just repeating this scenario again because we did scenarios in our custom security analysis before. For point to point, all you need to do is just click on have a particular start date. Let's say we are having a start date here itself. It's a election period for that US market, and you can see that the absolute data points, you can sort it. And just removing our Mirai asset, you can see that two of the stocks were in negative at that period, and this is an absolute data sets. You can analyze these data sets if you want. It analyzes any data sets which you have chosen, any date sets, and you can make 5 sets of scenarios accordingly with a start and end date. So any start and end date which you choose, let's say 2019. Now you can see that two of the stocks were negative in this period, 2018 and 2019. It's a 1-year period effectively, and you can analyze this accordingly into our system. So that's how the point to point analysis works out. There are other tabs as well. I'm just gonna give a brief because it will require another session for it. The brief here is that you can check the risk and return for any particular assets, even the custom securities compared into our system. And another thing is that these custom securities uh, are actually also very, very useful when you want to add it on a portfolio approach. Now, what about portfolio approach is that let's say you have already an existing model portfolio. Let's say we are just adding a model portfolio from here, right? And this model portfolio consists of only Indian mutual funds. Now, what we are trying to achieve here is that let's say hypothetically we are removing three, funds here, 2 funds here, and we are adding our own Vanguard, index fund, versus also we are adding a couple of equities. So let's say JP Morgan, right? Even Microsoft, right? So I've just added a couple of them. You can add as many as you want. We are just rescaling them to 100. And once you run it, now you can run this custom security with your own mutual funds or even an Indian stock based portfolios. And then you can check all the analytics like, how much it has been allocated as per the requirement. And also you can check the contribution, which is another great way to see that based on the allocations which you have provided, which one is actually contributing highly towards that portfolio. So on a portfolio approach with a start and end date, let's say we are considering a start date of 2019 till the current date sets, you can now see that our index fund is actually one of the least contributing asset in our portfolio as of 2019 to 2023. So that's how it works out for the system. And then you can check on a particular level, even a correlation will work out. You can see the correlations between each other, and that's how the portfolio approach is. Another bonus point here is, I'm just going to discuss this because that will require another session anyway, that any model portfolio can also be a custom security. Now, if you want to compare many model portfolios, you can do two comparisons of two portfolios here in the compare tab. Compare two portfolios side by side. But let's say you want to compare 3 to 4 or 5 portfolios. How do we do it? So the point here is you can make them as a custom security by downloading the prices in our system. So the price series is given here. And once you download the prices, it's given here. And then you just take that prices similar to what we have previously discussed before, and then make it a custom security. So let's I'm just going to show this tutorial again, that you just copy this price series. Now this is a price series of our portfolio. You copy this and paste it in our custom security tab here. Once you paste it here, once you add a security and paste it here, you can then validate the input, and now you can definitely see that this is what our portfolio is with the data point. Now this can be our model portfolio, which can be saved as a custom security. Now the last point, that once we save this as a custom security, then you can now run the model portfolios in the compare securities tab here in the system, just by taking into consideration all the strategies you have. So let's say we are just running a strategy here in the system. So this is our equity strategy model portfolio, and you can now see that our equity strategy model portfolio is also added, which can then map it out in our risk versus return tab. So in the risk versus return tab, you can see that I'm just going to zoom it in, and you can see that Mirai asset as an individual fund versus our equity strategy, which contains some of the funds and some of the stocks as well. We are having a conservative approach and better return sets in the period of 2018 to 2022. Now, this is how you can map it in for any database and compare it in our system. Now, this is another session anyway. So this is just one bonus point I've shown. This session will definitely now currently we have completed our session. So we will then open our forum for the Q&As. So if you have any questions, you can either write it on the chat box or verbally, and we will try to address them.
Hi. Hello. Hello.
Yes.
Is my voice audible?
Yes. Yes.
Yes,
Hello.
please go ahead.
Go to compare section. In compare securities. Yes. Go to performance chart. Performance chart. Hello. Hello.
Yeah, we are at performance chart.
Yeah. So what level you have used on y-axis? I mean, it's a return or some stock price. I don't understand.
Sure. So here, obviously, these are various different securities with different prices. So what we've done is we've rebased them at the start date, whatever start date you use. We've basically forced all the prices for all securities to be starting at 100. And then based on the individual daily returns of their own price series, we have rebased everybody to start from 100. So you can do a fair comparison.
Okay. So can't you give any, I mean, any like glossary, something that what is available on y-axis, or some tab available there, so we can easily understand what is available on y-axis? I mean, there are so many tabs where we can understand what's available there.
Sure. Yeah, we'll definitely add more information. We do have an FAQ section. We encourage you to look through that. We have quite a few answers. Umair, can you just quickly show? So here, we've got a few articles in here. We will, of course, add more, especially the ones you were talking about, but quite a few of the things you might find answers here. If not, obviously, if you have any questions, you can ask us on the weekend, on the Friday calls. but you can also write to it as support at NGEN Research, and we'll walk you through it.
Okay. Now go to portfolio section.
Yeah.
Portfolio section, and can you highlight about improve section? Improve. Yeah.
So basically what this does is, there is a portfolio with 5 or 6 funds here, and they're equally weighted, as I think that was, or no, they were slightly different weights, right? So if you look at the original column here, right, these are your initial weights. Let's assume that this is a client's portfolio, right? So what this section lets you do is it lets you run some mathematical processes to see if there is a purely mathematical way of improving these allocations. And the definition of improve obviously is very open. It can mean anything. So what we do is we give you 6 different suggestions, right, of how this portfolio can be improved. Now, before we look at the 6 columns, just have a look at the column on the very far right side, which is called equal weights, right? We've given them for reference. So basically, for example, to this client, you could say that, look, this is your portfolio. Your portfolio weights are 15, 15, 17, 25, 20. Even if you would blindly put 20, 20, 20, 20, 20 each, right? Even then the portfolio Sharpe ratio would be higher than what you have. Right? So that shows that their weightage method is actually not very good, because even equal weightage is doing better than what they have, right? So then you can say that either we go equal weight, or let's go and use some kind of strategy. So we have 6 different, kind of models that are giving you various different types of answers, and none of this is right or wrong. It is up to you to use if you want. Right?
I mean, how is this model working? Ranking models and value models. Can you
So we have 2 major models: ranking models and value models. The ranking model, what it does is it takes the 5 funds. And creates a literally rank meaning, first, second, third, fourth, fifth, right?
Rank them according to their returns.
So either return or volatility. Volatility will be ranked opposite, because the lower volatility is the first one, right?
Got
Sharpe is just like return. The higher Sharpe, the better Sharpe.
Okay.
So
I understand about the ranking models.
Okay.
And then after that, after giving ranking, then you will add all the ranks. Then you will give proportional weight divided. I mean, all the ranks and sum of the ranks, individual rank divided by sum of the ranks.
So somebody who's come first, in this case, Tata Digital has come first in the ranking returns, right? So it's got a very high weight, right? While the last is Axis Blue Chip has come last in this time period, right? So it's got the lowest weight. So these ranking models are generally speaking quite concentrated towards the best performer, right? Now here in the volatility one, if you look at it, it's kind of opposite, right? Actually, it's exactly opposite. Why? Because obviously Axis Blue Chip Fund has very low volatility. Tata Digital Fund probably has very high volatility, right? So, but in this case, so that's the kind of result you get. But here, in all 3 ranking models, you will get a result which is very concentrated, right? In the value model, that's a different kind of model. It is more balanced in its approach. So there it basically looks at the reason we call it value models is because it focuses on the actual value of the return or volatility or Sharpe ratio, right? So here also we know that Tata Digital in terms of return has come first, right? And you can see the portfolio weight of Tata Digital, it's 2265, right? Now it is still the highest weight, but it is only slightly higher than the next one, SBI Small Cap. Right? Because that, as you can see in the ranking column, it's second, right? 21.9. But in this case, the difference between the weight of Tata Digital and SBI Small Cap is very small, because most likely the returns of them are quite similar. So the ranking model can sometimes be very unfair in the sense that SBI Small Cap may be just 1.5% below Tata Digital, but it's got half the weight, right? But in the value model, that problem does not happen. So what it does, it gives you a more balanced portfolio, where how much return you've got is also important, not just the fact that you're first, right? Right. So
I got a math behind ranking models, but what is the math behind value models?
See, the math behind value model is very simple, right? It is looking at the actual value of the return, right? And after that, using that as a portfolio weight and then normalizing the result so that it adds up to 100, right? So it's a very, very simple model But usually we've seen, I mean, generally speaking, the more simple the model is, usually the better it is, especially with finance. So in volatility also, you can see, it's not, the result is not bad. It's 0.57 ratio, for Sharpe ratio. If you look at the value model, which is min vol, right? There you're getting a Sharpe ratio that's definitely higher than what the client has, right? A reasonably okay Sharpe ratio. So again, there is these results, whether or not they will be useful, that is depends on situation, from each situation. But and ranking models are, however, useful if you're really going for it, gunning for the return. Then you want to use that, and then every 3 months run it again to check how much changes have happened, right? So these are the two different types of model. Value model is more balanced in its approach. Ranking model is more aggressive in its approach.
I understand it. How do you come to about the proportion you are giving in ranking models? But how are you giving proportion in value models? In ranking models, what are you doing? You are ranking all the stocks as per their returns. Then you are adding all the rankings in accumulative terms. Then you are dividing all the rankings individually, and then you are giving the proportion. But what are you doing in the value models?
Value model is simply taking the value of the return. So if Tata Digital Fund return over this time period is, let's say, 35%.
Okay,
right?
Okay.
And SBI is 32%.
Okay.
Then we will allocate the weight of Tata Digital to be 35, SBI to be 32, and so on. Okay. And after that, we will
then total sum. Then if you are giving like this, then the total sum will be more than 100%.
Of course. Yeah. It will, let's say it's 140, right?
Okay. Then
you have to divide everything by, scale it down to make 140 equal to 100. Proportionally rescale. It's the same thing that you do in the portfolio section. You can rescale a portfolio. It's the same thing. Right? So so as we've said many times before, none of this is like, it's not rocket science or anything. It is basically using the data in a meaningful way, right? And using it. So for example, if you look at the volatility model, right? That is
just like pro rata basis, we can say,
absolutely
the higher returns you are getting. Yeah.
Yes. In the volatility model, however, things get complicated because you don't want the higher volatility.
Yes.
So we have to use an inverse. We have to do 1 by vol.
Okay. Understand.
Right? And then obviously normalizing that will become a little bit more complex, but again, we do it in this way, right? So volatility has to be inverse because, otherwise we want the low vol funds to get higher weight, right? And if you use volatility as a weight, then you'll get the higher volatility funds to have higher weight, right? So we have to invert it.
So if you have to choose between ranking models and value models, the value model will be more preferred over ranking models.
See, that depends. Depends. If you're looking at a long-term stable investment, I would go for the value model, right? If you're looking for a bit more punch in your return, maybe you want to have a slightly aggressive portfolio, then ranking model will work quite well, right? As you can see, the results are pretty good. Now, the thing is, only thing I would say is also, please make sure that you do also look at the minimum vol model, because especially if you get a minimum vol result, which has a good Sharpe ratio, it is definitely worth considering. You just have to make sure the return, you're not giving up too much return, because this is minimizing volatility, which is a really good thing. So even if you're giving up 1% return or something, it's fine, but you are definitely staying away from high vol funds, which is generally speaking a better thing to do.
Okay, got it. Thank you so much.
No problem.
Hello.
Yeah, hi.
Can I speak? Yeah. You just said that better Sharpe ratio for minimum volume model. Higher the Sharpe, better it is, right?
Sorry, say again, please.
You just said that last sentence.
Yeah.
Minimum volume has a better Sharpe ratio. How it is better?
Oh, the reason that minimum vol has a better Sharpe ratio versus the original, which is 0.53, right?
Compared to 5.3, it is minimum volume for value. Okay.
Minimum vol for value model. Yeah.
And why can't you have Sortino ratio compared to Sharpe? Because Sortino covers negative only, right?
That's true. That's true. But there are some other issues with Sortino also, right? Because it's a very selective way of saying that, because if you assume that all positive return volatility is good, right? That doesn't sort out the problem that if I take a lot of risk in the market, right, and I get lucky, I'm going to get 2-3 very, very good returns, right? Point is, I'm still doing something that is risky. So, you can take Sortino, but Sortino does have the issue with it is that it is only considering volatility when it's a loss, right? So that is fine, but don't forget that if you're experiencing volatility, whether it's positive or negative, it is a risky thing. A stable investment is not going to jump 5% in one day. That's just never going to happen. So, which is the reason that to get a proper result, which is maybe balanced in its approach, we purposely use Sharpe ratio instead of Sortino. But again, we can look at models which run on Sortino. It will definitely give you more risky portfolios because not all positive returns which are high vol is a good thing.
So correct me if I'm wrong, if I understood it. Sharpe ratio covers both, right? Positive and negative. So it is more.
Yeah.
It gives more balanced picture. But then, if you want to have a riskier portfolio, which already tells you what is the risk based on the data.
Yeah.
In comparison of Sharpe or Sortino, which one is better to look at?
See, again, this is a personal investment choice. If you ask me, I would say I will always use Sharpe ratio, not Sortino, because in the calculation of Sharpe or Sortino, the denominator in Sharpe is your standard deviation of all the returns, right? But with Sortino, the denominator is standard deviation of only negative returns.
Right. Yeah.
Right.
Yeah.
So in my opinion, I mean, it's fine for certain types of analysis, but in my opinion, it's also a bit biased because you're basically saying that if an investment jumps 5% in one day, but it goes up, right? Then I am not going to consider that a risky thing. But in my opinion, that is risky because no investment can jump 5% up in one day and call itself a low risk investment. It's not a FD, is it? So it is jump 5% means there's a chance it can drop also. So so that's the issue with Sortino, which is why we don't have a Sortino model here.
So according to you, if you have to prefer which you are saying Sharpe ratio.
Yes, definitely.
And can we have my second question was which I was already forwarded in the chat box. Can we have this comparison for or is it feasible, it's required or it's possible to have along with Sharpe ratio, even standard deviation, Sortino and alpha?
I believe that Umair, can you quickly just go to the compare portfolio?
That is there, but in portfolio comparison.
Yes, portfolio comparison, you can load two portfolios side by side. So even if you got the result, you can have the improved portfolio result. You can easily save it as a portfolio. There's a button there also. And now you can put two portfolios side by side. And let's just look at the stats. If there is Sortino there, I'm not sure if it's there. Sharpe is definitely there. So if you scroll down, yeah, so we don't have Sortino here, but that is something we can add.
No, here I'm okay. I know that here it is not there. Here also it is preferred to have Sortino as well. But in that comparison section where portfolio is there, so is it feasible or advisable to compare? You just compare basis on the Sharpe ratio, right?
Yes. Yes.
In compare, go back to that previous slide or whatever portion section was there. Here.
Okay, you mean the I see. You mean when you're looking at the portfolio improve result.
Yes.
Okay. Yeah. Fine. I understand.
It's possible to have those parameters as well.
Okay.
Better picture.
Yes.
Comparing on the basis of Sharpe ratio, not alpha, not deviation, standard deviation.
Okay. Yeah. So that's fine.
Negative correlation or even information, all those things. So
Understand. So someone please just write this down. So we will add a Sortino ratio line just above the top three here. And we will also add a Sortino ratio line in the portfolio comparison screen.
And will it be more complicated or how then?
No, we can, because these are results, they are just calculating the stats of the models that we are showing you, right? So we are only showing you three things: annual return, volatility, and Sharpe ratio of the results, right? So here we will show you annual return, volatility, Sharpe, and Sortino.
It will be a better picture.
Yes.
And could you please quickly, though you are explaining, I still didn't get it. How you will differentiate between a ranking model and value model?
See, ranking model is basically, it will always give you a more concentrated picture, concentrated answer, right? and you will always see, let's say there are, how many, there are 7 funds here. It will give a lot of weightage to the top 2-3 funds. So the weighting is kind of exponentially, reverse exponential. So it's very big, then it becomes smaller, 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 smaller as it goes to the last fund. So you will end up with a performance which is usually better. You can see 0.73 Sharpe ratio. But it is also more concentrated. You can see a lot of money is concentrated on SBI small cap, right? SBI small cap, Axis mid cap, Mirae asset, that's 50-60% of the portfolio right there. So concentration will be high in the ranking model.
Right.
On the value model, you will get slightly worse result in terms of return. You can see return is lower. You can see Sharpe ratio is lower, right? Compared to the rank return model. But here the portfolio will be more balanced. So risk will be lower.
So these percentages are basically, this is the proportion of the portfolio?
Yes, proportion of the portfolio.
Returns.
Proportion
right,
of the
based on the returns therefore.
Okay. Yes. So here, so proportion. So if you want to, for example, let's say you want to use the value model return column, this one, you can just click on the save button on the top here, and you can just put that whatever name you want and click on create. Once you do that, it gets saved. So may I just close this window and just show. Actually, first show it in the portfolio section, so they know that it is there. See, there you go. Optimize from improve inside the from improve folder. That result that we just got, we saved it as a portfolio, and there it is. This is the portfolio.
Actually, there are a lot of questions in my mind, so, but I think other people are also waiting to ask.
No problem, no problem. So please, sir, just drop your name here. We can arrange a training session for you.
No, training session is all fine, but just could you please go back again to that pre-portfolio one again?
Yeah. Just click the improve. For I mean, I guess on this one it might not work because it's already improved.
So if I'm not wrong, this particular analysis also, correct me if I'm wrong again, then I'll first see which Sharpe ratio is better, and
yes,
value model, and the current portfolio returns were considering this slide only.
yeah.
Is that client's portfolio is 13.34, but if I choose say
rank return, see
or returns values model
return, yeah, fine, yeah,
or even Sharpe value. So if I want to choose portfolios, then I'll go first give preference to rank Sharpe based on the ranking model.
yes,
but value model 15.14 is better. So I'll last portfolio proportion.
Yes. And
for the
here,
client, I'll recommend him instead of that. This is the reading. Is it correct?
Yeah, that is correct. And one more thing I will add is ranking model is something that you should probably check and rebalance maybe once a month or more frequently. The value model may not require that frequent rebalancing, but with the ranking, with the ranking model, you should probably come back here every 30 days or 60 days to see if the situation has changed.
And the data which you have taken is how much for? This is my last question.
So you can see it's from 2011 to right now. You can change this input data also, and then the results will change.
Can we take it from any which way, from where client has invested, but any which way you might have not invested in the same date?
Yes. And that, see, when the client invested is got nothing to do with which fund is best, right? So when the client invested should not be considered, in my opinion, because that is the client's own personal story, and as far as investments go, it doesn't matter. Because
so we should take as long data as possible. Sorry.
Yes, you definitely should.
And irrespective of, sorry, yes.
No, I'm saying that unless you feel that you don't want to consider the COVID period because it was really crazy. So you might say, okay, I'm
let it be now, whatever is fact is fact. But
exactly.
That's fine. But then if I'm taking 10 years data, so based on inception date, it will face that data, and so it seems might be 5 years old. So
exactly. And you see, when Umair just changed it to 2017, SBI small cap was still winning. So that's a good sign, because if you keep changing, see, again, SBI, it's continuously coming as the first, right? So we are changing time periods here, and it seems to be the best. So that's a good solution.
So you are saying COVID data you should avoid, skip, or
No. I said if in case you want to. I'm not suggesting it. In my opinion, you should not avoid any data.
Yes, exactly. Yeah.
Yeah.
Yeah. Thanks a
Hello.
lot, Mahendra.
No problem.
What's your good name, please?
Arunab.
Arunam. Okay.
Hello.
Thanks, Arunam.
No problem.
Hello.
Hello. Hi. Yeah. Please go ahead.
Hello.
Yeah.
In case of SIP, which portfolio model is preferable?
Well, with SIPs, the analysis that we show is always with one simple fund. But if you're looking at SIPs, I don't think that the result will change whether you do SIP or lump sum, because at the end of the day, SIP is just a different way of getting into the same portfolio. You're putting some money in once a month. So technically speaking, your investment methodology doesn't really need to change whether you're doing SIP or lump sum, because if SBI small cap is a good fund, it's a good fund whether or not you do SIP or lump sum. So I would think that if you're doing SIP, nothing should change from the investment research perspective.
नहीं
That is just, money coming in.
अभी आपने बोला कि
हाँ जी।
ये जो रैंक मॉडल है वो
जी।
आपने चूज किया तो
हाँ जी।
2-3 मंथ में वो चेक करना चाहिए, तो SIP के केस में कुछ 2-3 मंथ में हम लोग चेंज नहीं करते ना, तो
हाँ देखिए, तो ये एक इशू होगा। जैसे अगर आपने लमसम किया है तो अगर 3 महीने बाद जो पोर्टफोलियो के रिजल्ट्स हैं वो थोड़े चेंज हुए हैं, तो आपको क्या करना पड़ेगा, आपको सारे SIPs को एडिट करना पड़ेगा।
हाँ,
अगर आपके 8 फंड है तो 8 SIP की आपको एग्जिस्टिंग पोजीशंस को भी आगे पीछे करना पड़ेगा। अगर लमसम है तो इट माइट बी इजियर कि आपको थोड़ा सा इधर उधर करना पड़ेगा टू मैच द न्यू पोर्टफोलियो। बट सो SIP में ये इशू तो है। अब आई मीन दैट इज अ प्रैक्टिकल इशू। सो बट इफ नॉट 3 months देन आप एवरी 6 months करिए। बट you should, ideally speaking, as the market moves on, portfolio should be readjusted.
Okay.
Thank you.
Thank you.
If there are any other questions, please let us know. Okay, if there's nothing else, Umair, we can close for today.
Thank you so much, everyone, for attending this seminar. And we will come up again with new topics and with new session altogether. So meanwhile, we come up with a new topic next Friday, 4 o'clock. You can always check out our videos panel. So, we are actively updating short form videos for NGEN markets, we NGEN shorts. So there are a couple of questions you had might be the one which you can actually solve here itself. All you need to do is just search query and you can definitely see how you can, how these short form videos will solve. So we have added more than 60 videos and we will be adding more than 100-200 videos for your references. Another thing is that you can also take a look towards our updates. We are actively adding updates, so check it out. And that's it for today's session, everyone. Thank you so much and have a nice weekend ahead.